It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. I started the Tiger TV with a chart from one of our den members, Zitao, JC from Philadelphia. He does an incredible technical amount of work, and he is an exceptional trader. And we share a lot of information. But this particular chart that he sent me, I believe, is worthy of everybody to take a look at, because what it does is it goes back from 2009 to the present area, and what he does is he selects the major lows and shows how they're related, to the Fibonacci numbers that we use. The first one is 382, the second one is 786, the third one is 618, the next one is 50% in 382, the next one is 61% retracement, and so on and so forth. But what it shows, if you get a chance to go in and look at this, and it's really a beautiful chart because it shows the blue lines that look like a trend line, and it's drawn like a parabolic line, because trend lines are actually parabolic. They're not drawn in straight lines like the whole world draws them. They really should be drawn by parabolic lines because they should be connected by the Fibonacci numbers that make the lows or the highs, to determine that, and that makes it look more like a jagged line, which is really what the market's doing by going up with the ABCDs. But I really highly recommend you take a look at this chart because it is really a really nice picture of what really is happening with the market since 2009. John is really excellent with the patterns also. He didn't draw the patterns in to keep it from being too cluttered. But, you can see now that there's a potential for a three-drive pattern up in here with the SPX up at the 1507 area. But whether that happens or not, we'll have to wait and see. It's still, the Fed is out there today, so, anything could happen. But that's something that I think is really worthy of folks that don't believe in Fibonacci numbers should take a look at this just to see how close these numbers are to the actual lows, because it's really quite amazing. And if you add some cycles in with it, you get a better idea of that the market is really non-random, that it is predictable within limits, and that's really what we're trying to do. Now on our show on Monday, we were right at the moment of truth in the gold and silver markets. And the gold hit the exact 61% retracement down there that we had talked about at the 1651 level, and we've now rallied over $30 an ounce. So that level is going to be very, very important now for the gold market, because it has held a level that is incredibly important. We ran into a little bit of resistance today from a longer-term 61% retracement going back to 1695, but this market has really poised now to move a lot higher. It did everything that it could have to fulfill the objectives. We had a three-drive pattern occur on Monday. We had the little move up and then the pullback down to that 1653 level. In fact, we were on the air when that was happening. And, we were suggesting that if you wanted to look at the gold market for a long time, this is the place to do it, because you didn't have to risk an arm and a leg. And if you happen to do that, then, you would be taking some profits in this area. And, of course, moving your stops to above break even, I would put the stop probably around 58 or 59, just to be safe. That's what I would be. That's what I would be watching. So the gold and the silver have turned, and so that's what we're keeping an eye on that. Now I want to give a tiny bit of. I'm going to get on my soapbox for just a little bit here, because there's something that I watch that I don't think everybody fully understands. And what I'm going to do here is I'm going to put in the Japanese stock market, and because it's making new highs. I wanted to show you why these ETFs are so difficult, in my opinion. Some of them are. Some of them are easy. I want to show you the easy one later, but I want to show you the harder one first. But if you'll take a look at the Japanese stock market on the daily basis, you see that we're getting ready to form a three-drive pattern near the old highs from 2010, and we'll see if that happens. But the main thing that I wanted to get across here is to show you that when you trade these ETFs, they are so different than what is really happening in the real world in some of these that it's really amazing. And this is a really good example because I posted the second chart showing the Japanese stock market, and then I overlaid on top of that the ETF. And you can see the divergence here is huge. You know, the ETF has not even taken out the 2012 high. In fact, it's only gone to the 78% retracement, and yet the futures, the actual, you know, the Nikkei Dow and stuff has gone to a 1.618 expansion is almost testing the 2011 high. So this thing is really not very fair. I mean, you know, you think you're buying something, and yeah, it's moving a little bit, but you know, it's not moving anywhere near the way that it really should, the way that it should do, and that's fair. That's why you've got to be really careful with these particular ETFs, because it makes it, you know, a little more, you know, difficult to do that. Now, some of these ETFs are very good. Let me just show you the Dow Jones using the diamonds, which is the ETF for the Dow Jones Industrial Average. This has nearly 100% correlation. It probably is 100% or 99 correlation. It just doesn't have any divergence at all. It's tick for tick, and you get, you know, the same bangs for the bucks. Now, I do understand that some of these ETFs have, you know, double leverage and things like that, and that, you know, skews it even more. So that when you're trading this, you really have to be careful how that thing moves. You want to get an ETF that tracks, I would say, at least 90% of what the markets are doing, and that's, you know, the really important thing, you know, to keep in mind. I wanted to bring out one other thing about this, and that's something that we talked about. We're going to talk about it tomorrow on the Commodity Show too, but we did talk about it on Thursday, and that's the DBA, which is the ETF for the commodity markets. And we've had huge moves in gold, silver, crude oil, you know, all of these things, and yet the DBA has had a very, very small movement. I mean, you know, virtually nothing. It did hold the 61% retracement, but as far as having a big move, you know, we're not having that as of yet. And believe me, you know, we're at a big time 786 retracement in crude oil, and you know, silver and gold have been strong. The corn has been strong. The wheat has been strong. Beans have been strong. And even cattle have started to rally a little bit. So this is telling you this, even though the DBA is supposed to be a proxy for commodities, it doesn't give you the bangs for the buck that you get, you know, with the regular thing. So just keep that in mind. And remember, this old cowboy knows very little about ETFs. I know about charts, but I don't know a lot about the ETFs. I try to research them, but they're a little more complex than I want to get into. But when I see a chart that is diverging badly from what it should be showing you, then I would say, you know, there's something wrong. The SLV, the ETF for silver, and the GLD for gold, those work pretty well. The problem, again, arises sometimes because they're not 24-hour markets. You're going to see some gaps in there, and you're not going to see some spike lows and highs that might be in the futures market that could actually, you know, be in the that won't be in the ETFs, but they'll be in the futures market. But right now, the key to watch is that 1651 level in the gold. It held absolutely perfectly, and that's what we're really looking for. And the gold, you know, remember we showed the gold and silver index that silver was actually holding up better, and it in fact did. It couldn't make the 61% retracement. It only came down to the 50% retracement. So we'll see if that's going to have anything to do with this. The reason why I'm spending a little more time with the gold and silver today, it goes back to what Basil was talking about with the U.S. dollar and stuff. We might be at a point here in the U.S. dollar where it says sayonara. In other words, the Fed is going to come in and just, release the brakes and, let this thing, get out of control. And, we could see some, pretty serious inflation coming back if, in fact, it does that. We will cover the effect. Let's just do the U.S. dollar now. We've got time before the break, and we should take a look at it because we're at a really critical level. We've been making higher bottoms, but as of today, we took out the bottom of last week, and that's a pretty negative sign. And if you get a chance to take a look at this, we have a potential for a double bottom coming in at the 786 at the 79 level. That's 78.93. We're trading at 79.32 now. But if we break below that, that's setting up a huge ABCD pattern from the July level of at 84 in the dollar index down to that 79 level one more time, and then we rallied up to the Gartley sell signal at 81.50. That sets up a price objective of 76, and that is nothing more than a very large Gartley pattern going back more than a year and a half, and that would take us down to the 76 level if we break down. This could be what the Federal Reserve is doing as far as trying to liquefy our debt. In other words, they're going to pay every dollar back, but they're going to be with dollars that are not worth nearly as much as the people when they first bought these things. So that's one way of doing it. The other way is if they repudiate the debt, and I don't think that's going to happen, but we'll have to cross that bridge when we come to it. I still believe that this week is a major week for all kinds of cycles that are happening, and I think it's important that we pay really close attention, to these markets because they're going to tip their hand pretty soon. The one that we've been, taking a look at from a stock point of view is excuse me, I'm stuttering here. Is the stock of Amazon, and the reason why we're doing that is that Amazon had many of the same characteristics that Apple had as it was making its butterfly pattern up around the 700 level. And we had a big break in the Amazon yesterday, and then we had good earnings come out, and then the market rallied back and touched the same high again up at that 284 level. And so that's the main thing that we're looking at on Amazon here. And this is the suggestion that I would make because it's a very expensive stock and it moves around quite a bit, is to look for a put, that's like one strike out of the money. Like go into this is we're basically in February. Go to a March, maybe a March 250 because it could easily do that. We have to take a little break here. And then we'll come back and we'll talk some more about the euro and also the Japanese yen.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. TFNN is proud to partner with Great Panther Silver for another exciting silver coin giveaway. The Great Panther Silver Super Silver Giveaway begins the week of January 28th and we'll be choosing 47 lucky winners. It's free to enter with absolutely no strings attached. Just visit the front page of TFNN.com today to fill out your entry form. Every hour that we're on the air, 9 a.m. to 6 p.m. the week of January 28th, we'll be randomly choosing one lucky winner that will win a silver coin or bar from Great Panther Silver and TFNN. And the final hour of the week, Friday, February 1st, we'll choose 3 lucky winners. That's 47 winners in just 1 week with over $1,000 in silver given away to our loyal listeners. Register today by visiting the front page of TFNN.com. And for more information on Great Panther Silver, you can click on their banner on the front page of TFNN.com or check them out on the NYSE Amex symbol GPL or on the Toronto Stock Exchange symbol GPR.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and before we talk about the Euro, we want to announce the winner of the Great Panther Silver giveaway is Russell from Seminole, Florida. So, Russell, if you're listening, please give TFNN a call at 877-927-6648 and claim your prize, because if silver is moving out of here, it's trading, around $32 an ounce, and frankly, if it gets above $38 an ounce, it could double in price, because if the dollar goes to, 76 or below, believe me, gold and silver will really move, and we'll have some, plenty of lead time on this if it is going to move. But the real key now is to see that it can get out of this level in gold. Silver is just too difficult to trade. It's so much thinner than gold. Gold is the one to look at. But if we can clear the gold above that 1,700 level, which is about $15 to $20 from where it is right now, then it can go a long way. The good part is that in 2 days, it's covered well over $30 in a matter of just a few days. So that tells you that there's a lot of power in the gold market. I've been following the open interest like I usually do. I haven't seen anything really dramatic as of yet, but we did have a little bit of a increase in volume, which was pretty good for the test that we made on Monday. Okay, let's get to the euro now, because this is related to the dollar, because it's basically 53% of the U.S. dollar index, and we have broken out to the upside. We had a lot of resistance at that 133.50 to 134 level. That was the the 61% retracement off the last high. There was a really nice ABCD level there. And not only that, but it held there for 8 days. The euro had a great deal of resistance at that 133.50 to 134 level. And when we broke through that 2 or 3 days ago, that was telling us that it pretty much wanted to go higher. And now that sets up a larger AB equals CD pattern, 200 pips higher than where we are now, up at the 138 level, which is the 61% retracement, of the whole down move from 2011 through 2012. And that could make that easily, and it's still a bear market. Remember, folks, when the euro was making, its bottom, down in the making a double bottom in late July, early August, and the Greece was going to dissolve, and Italy was going to dissolve, and Portugal and Iceland and all the others. I mean, this, I don't know if it was Italy, Spain, and Greece and Portugal. Those were the pigs. But the market turned, and it's had a tremendous rally of more than 15% in a matter of just about 6 months, and it can still do that in a bear market because it did the same thing in 2011. So just because it's having a rally here, and it can still go higher, it can still be bearish. But what you're trying to do is to select a point where you don't have to risk a whole lot. The risk is selling the euro around that 133.50 level that we talked about several times last week, and it went down 100 pips several times. But the problem is it would always come back, and then when it finally broke out above the 134 level, it started to pick up steam, and it's still doing that. It's still starting, to move, a lot faster. That's the same situation that we had, in the Japanese yen, where the yen, would just not back off after it, made its final bottom down around that 72, and then made the secondary bottom at 75, and then, off it went to the races. We owe a great deal of gratitude to our fearless leader, Tom O'Brien, because he was the first person on the bandwagon on the Japanese yen down there at that 72 level. I followed a little bit later, and it certainly, turned out to be a pretty good trade. And I think this is just the beginning. We're due for a really substantial correction here. Whether we're going to get it or not, I don't know. But everybody has become, incredibly bearish the yen, and so this is the time where you usually come into a point where you're going to get some type of correction. There is a pattern forming in the Japanese yen on a shorter-term basis, that 3-drive pattern that we posted last week, and we did exceed that by just a little bit today by a 1.27 number up at that 91.50 level, but that still is within the ballpark of completing that pattern. So it doesn't mean that it can't just keep running to 95 and then 100 or whatever, but we'll see. Anyway, we've got to take the longer break here to pay a few bills. If you have any questions, it's 877-927-6648. And we come back, we're going to cover something very important in the Treasury bond.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and I'm going to talk a little bit about the Treasury bonds, and we're going to go to a weekly bond chart looking at the 30-year bond. We are almost exactly at the 61% retracement from the March low of 2012. We've done it in AB equals CD fashion, which makes it a Gartley pattern. The key here is if the bonds go below the 141 level, I think then this thing is really going to accelerate, and interest rates are going to get a lot higher. What the Fed has been doing with this QE program is experimental, and no one really knows what's going to happen when it starts to unwind. And history usually says that when somebody does something like this, it usually backfires. But history can sometimes be wrong. But we'll see how the history book finally comes out. But this is a really important time frame in the Treasury bonds. In fact, it's important in everything. I mean, it's in the commodities, it's in the stock market, it's in the bond market. So these cycles that we're over are quite important. But the level of this 142 and change in the Treasury bonds is very, very important. Now, the Fed is meeting today. Their FOMC, I think it comes out at 2:15, if I'm not mistaken. And that'll probably be, something, pretty wild. That would be my guess. I know we have the trade of the year on in the stock market, where we're short the S&P, and we have a stop at 115.07. We missed that by 1 penny or 1 point last night so far. But frankly, with the Fed out, today, I would not be surprised to see a spike either up or down. And, if we get stopped out, so be it. But that's the name of the game. And that happened to me last year. I got knocked out on the high. But that, that's just all part of trading. Anyway, this will be my last trade of the year. I'm not going to do them anymore. There's just too much pressure for me, and I just can't answer all the questions that people have because I can't tell people what to do because I don't know what their risk is. They have to take the responsibility for that. I tell them what I'm doing, but, they ask for, option strategies and things like that, and I know enough about options to write on the head of a pin in boldface type. So an options person, I am not. I would recommend looking at Larry McMillan's books because he does a great job with options. And there's some great options programs out there that, help you. But you've got to understand, some of these, the Greeks that are in there, the alphas and the deltas and the betas. So because an option is a decaying asset and it, you can be right on the market and still not make any money, and that's not a fun thing to do. But anyway, the bonds are at a extremely critical level, setting at the 61% retracement. Now, this could be the same thing that happens in the bonds because if the bonds are turning here, this means that possibly the stock market could be turning, and that would fulfill the other part of the equation that if stocks go up, then we'll be looking at something where the bonds go up and the stocks go down for a period of time because it's been running that way for a while. Now I'm going to put into Tiger TV the Dow Jones E-mini daily, and it shows the time and price parameters that we put in last week, and we are 2 days past the exact date that we were looking for. The full moon date came in on the 27th, and today we're at the 30th. So we've made all the objectives in price, and we're now 2 days past the time. So if it doesn't turn down from here, who knows? It could be in an outlier event that we've never seen before because the Dow's up 6% for the month of January. And tomorrow being the last day of the month, it's going to be really difficult for a collapse on the last day of the month. But the main thing is that this is one of the larger gains that we've ever had on a monthly basis. I mean, you go back and look, I believe it's the 6th all time, and a couple of those were during the 1999 run when we were in the fruits and nuts area of the tech stocks when everything was moving 10, 20% a day. But the time and price things are lined up just the way they should be. And they have been, but the market just keeps, grinding up, and, I'm wrong, but I have to follow the patterns, and it looks like it might not work this year, but everything is set up, whether it turns down or not, we have to wait and see. There is one other positive thing that I see happening that Basil brought out. That is the fact that the VIX index that we follow did not, collapse here on the flash run-up that we've had. It actually has moved up for a few days when the rest of the market was going up. The VIX index, still started to move higher, and it's setting right over, the cycle lows of 30 days and 100 days. So it's a very, very important cycle low that we have now. But the fact that the market did not collapse in the VIX market in the last few days when we had these days where the Dow was up 65 and 75 and I think 80, the VIX was actually going up. So there is a little bit, maybe it's short covering, I don't know, but there's a slight positive there, the fact that it's over the cycle low, and that it is able to, hold above this when, the market continued to go higher. So whether it means anything or not, I'm not sure, but it's a sign that you want to take a look at it. Remember what happened from Christmas Eve when we made the bearish Gartley in the VIX index up around the 23 level. And here again, you have to give Basil all kinds of credit because when it was trading around 16, Basil said it was going to go to 22. and it went up there, and it actually completed a nice Gartley there, and then it had its worst week ever, where it dropped, more than 30% in 1 week. So these are the things that you have to look at, because the VIX index, even though people say it's dead and it doesn't count anymore, I don't believe them, folks. This thing comes to life at the weirdest times and shows you that fear and greed are the two things that really, run the market. So we're keeping an eye on this, and whether she turns or not from this level, we'll have to wait and see. But boy, we're certainly over some major cycle things, and in everything. And whether they all turn at the same time or not, or maybe they all fail, I don't know. But it's just really an amazing sequence of events that we have occurring with all the patterns and everything. Someone asked me the question, how bullish am I on the gold market? And my answer is that I'm very bullish. We had a nice $30 move off the bottom, and if we can get above 1695 to 1700. It could really go. We got a call from Max in Houston, Texas. Are you there, Max?
Yes, I'm here, Larry. Good morning.
Good morning. What can I do for you?
Well, it seems to me that if the Fed is supposed to announce, the meetings are going to announce sometime this afternoon about 2, and if they continue printing, gold should soar, rates should drop, bonds should go back up, but then the market probably will go higher, so that would is that a conflict with what you were saying earlier about the market being
no,
at a critical
Max,
junction?
it's not. The key to it, in my opinion, on the interest rate front is the U.S. dollar, because if the Fed really wants to put the metal to these people and really do a currency war, what they're going to do is they're going to deflate the dollar so that they can pay the bonds back with cheaper money, and so that the U.S. government, full faith in government, is paying the money back in dollars, but they're paying them back in cheaper dollars. Now, the question is China and Japan, being the largest holders of our debt, are they going to put up with that? And that's what starts these currency wars, and we'll see what happens. But you see now Japan is in a quagmire because they've had a tremendous rally now against their currency. But that currency at one time used to be 268, and it went down to 72. So there's a lot of room there for the Japanese yen to move. But your actual question is, all of that could happen. What you just said, stocks could go up, gold could go up, bonds could go up. They could all move together. You just don't know. Each one of them is separate.
Okay, because I'm very short on the market, like you are, and short on a bunch of equities, and I'm expecting a turn. So,
well, I am too. But remember, one of my favorite sayings from Tony Robbins is be very careful of your expectations, because all your frustrations in life come from unfulfilled expectations. Whether it's your children or your spouse or your preacher or your car or whatever. Whenever you're not happy with what's happened, that's what makes you unhappy, is you're expecting something to happen, and then it doesn't. Like the Super Bowl, you might think that the Patriots are going to win, and the Ravens might win. So that that expectation will make you have some problems. So try not to have too much in expectations. Just react to what you see. I don't know how big of a move we're going to have today. After the Fed, because everybody's expecting them to do nothing, and that's a dangerous thing too, because they could come out and say they're going to, start going back to pull back, quantitative easing a little bit. I think that would sell the stock market off a bit, but here again, that's fundamental stuff, Max, and I really don't understand it. I can see the prices go up and down, and I can watch the the price action. That more buyers, it's going up; more sellers, it's going down. But to explain the fundamentals, it's too much.
All right. Well, I do appreciate your time and your show.
Oh, it's my pleasure, and I hope it helped a little bit. I know I'm not much of a fundamentalist, but I watch Bloomberg in the morning to see what's going on, and they'll have one analyst saying one thing and another analyst saying another thing, and they both could be right. All I have to go on is what our price is going to be doing, and that's what I try to do.
All right. Well, I appreciate your time.
My pleasure, Max, and have a happy New Year, okay?
You too. Thank you. Bye-bye.
You bet. Okay, let's stay here with the bonds here for just a second, because we are at this really critical level of 142 in the bonds. They're they're about a point higher than that. They've been a little bit lower than that, about 15 ticks. But wouldn't be surprised that if the Fed comes out and that they could spike down and take out that 142 by just a little bit. But that would be very similar to what we were seeing in gold on Monday when we were looking at that 1651 level. It's the same type of the move. We spent a lot of time on that situation in gold. We looked at the gold and silver ratio. It was also making a retracement. The silver was making a 50% retracement when gold was making the 61% retracement, and that's the first time that silver has been actually leading the pack for a very, very long time. So whether that continues or not, we'll have to wait and see. But in about another I guess it'll be about another 15 or 20, another half hour, I think. No, another 2 hours and a half, the Fed is going to be out, and they're going to say something. And folks, I don't know if you know this or not, but the Fed they are huge speculators in the market. I think they have over 300 or 400 traders in their different, the 12 different branches that they have that do actual trading. And and people don't really realize that, but they don't have to report anything. It's a private corporation. It has nothing to do with the federal government. They use the name federal, but it has nothing to do with the federal government. The name of the thing should be the big private bank, is what it should be called. But, it's called the Federal Reserve, and there's nothing reserve about it, and there's nothing federal about it. So the misnomer of the name, confuses a lot of people. I recommend reading, the book, what is the name of that book? Somebody's going to have to help me out here, but it's one of the best. The Creature from Jekyll Island, and that is really a good indication of what's happening with the, with the Federal Reserve and stuff, that it's run by private banks. It's a private corporation, and it reports to no one. They do go to Congress, and, occasionally they have to show them what they're going to do, and they always say they're going to be more transparent, in other words, showing people what they're doing, but they frankly don't. So, this is something that we have to live with. Andrew Jackson thought that the Federal Reserve was the single biggest enemy that the United States had to face, back in the 1840s, and it was during his term as president that they didn't have a Federal Reserve. It wasn't until 1913 that they passed the Federal Reserve bill, and it passed on a Christmas Eve with just a minority of people there to get it through, and it stuck, and that's what we've been dealing with, ever since. So I'll get off my soapbox on that one, but we'll see how the thing transpires today, but it's always very, very crazy. The worst, let me not say the worst. It is the worst. The worst thing that the Fed ever did, in my opinion. We got to take a break, and then I'll get back to what I think was the biggest robbery ever in the history of the financial markets in '96. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we owe John Zitow a really big vote of thanks, because he just posted something in the Tiger's Den about Woodrow Wilson, who signed the 1913 Federal Reserve Act. And a few years later, Wilson wrote, "I am a most unhappy man. I have unwittingly ruined my country. A great industrial nation is controlled by its system of credit. Our system of credit is concentrated. The growth of the nation, therefore, and all our activities are in the hands of a few men. We have come to be one of the worst ruled, one of the most completely controlled and dominated governments in the civilized world, no longer a government by free opinion, no longer a government by conviction and the vote of the majority, but a government by the opinion and duress of a small group of dominant men." Well, that's pretty much what Andrew Jackson said about 60 years before that. So whether it will ever change or not, I don't know. It's pretty hard to change something that's been around for a long time. But if things blow up and, get really bad, then that's how they change. But we'll wait and see. I always felt I don't want to get into that. I want to move to the Japanese yen, because we have a pattern that is forming since early January that we've been sort of watching quite a bit, and that is a three-drive pattern. It's relatively symmetrical. It has a very nice AB equals CD pattern coming in here at this 91.40 level. We'll follow this, of course, on the commodity market tomorrow. but we'll also, follow it next Monday when we take a look at the rest of things. So we'll be into the real key date for the Bradley Index. That's the last really big super key date, in my opinion, is that February 4th thing. Someone remind me, the worst thing the Fed ever did. In 1996, I believe it was October, in the middle of the morning, around 10:30 in the morning, Alan Greenspan dropped interest rates 0.5%, and the S&P traded 50 handles higher before there was a trade. In other words, right now it's trading at 14 and 1500. Okay, back then the first trade would have been at 1550. That was at a $2,500 hit, and it bankrupted more traders than ever before. There were so many seats for sale the next day at the Chicago Mercantile Exchange. It was the worst way of ever doing anything like that, and he's not held responsible for it and everything, but he ruined many, many people's lives. And I think someone just told me that the price was it was 1998, and it was at 3:15 p.m. I got the years wrong, but that was Tommy O'Brien told us that. But that was really the time. Anyway, listen to this, folks. We're winding it up. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.